Well, greetings everyone, and welcome to the August 2017 edition of the Roundtable. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and we've been doing this program for about 7 years. We'll be joined here tonight by a full slate of damsel and knights. Kim Butcher of Evansville, Indiana, will be joining us here in a few minutes. She's attempting to get in, and my dear friend Ken Kavula and friend from the West Coast, Hugh McManus, are also here joining us tonight. And it's kind of a festive time for us. Middle of the summer, our audience will be down a little bit, but those of you who have come get to witness us in our tin hats. We're celebrating the eclipse. It got fairly dark here in the Detroit area. I understand down in the southern half of Indiana and Tennessee and those areas, a pretty dark swipe across the country happened, and anybody was able to see that. It's a pretty special experience.
Well, it was kind of a bust up here, Mark. We had a lot of clouds in the sky, and it really didn't do much to change the light at all this far north. We're another 60 miles north of you, but it still was kind of exciting to know what was going on and to watch what was happening on television. So it was worth all the hype, and they tell us 7 years from now we'll be right in the main path of the whole thing. So I'll be kind of excited. Gives me something to stick around for, right?
Yeah, Cleveland is right on the path of totality, so maybe we go down to Corky and Lenny's and
okay, all right, and have a nice dinner or lunch either before or after. Okay, Mark's referring to the fact that we've been traveling, and we did a program last Thursday in Northeast Ohio at the Mayfield Library. That's real near where I grew up, and we got to eat at Corky and Lenny's Delicatessen, a favorite of mine for my entire life. And then we went to Harrisburg, Pennsylvania, and had a wonderful group of hosts and a great program all day Saturday. And then we decided we were going to drive home in one fell swoop. So we drove from Harrisburg back to Michigan in, about 9 hours, Mark? 8 hours? About 8 hours.
Of course, one of the highlights of the trip was talking about the events of the next coming days, but just, again, getting to see the successful investors in Pennsylvania and northeastern Ohio. And again, I'm not sure how we got on the subject, but it had something to do with Punxsutawney Phil and all kinds of stuff. But I did write about a number of things, including this notion of you could watch the solar eclipse through a colander. And so that's what we thought we would use as a theme tonight. We also thought we might visit a couple of the themes that we discussed with those audiences, this notion of risk. Too bad Cy couldn't make it tonight. And this notion that a bear market just might resemble an eclipse. We did
for the cooks in the audience, Mark, I'm going to say it's a colander so that they understand what the heck it is you're talking about. Okay?
Well, that shows you how much time I spend in the kitchen.
I know.
Watching those. Actually, I do. I just don't know how to use most of the tools in the kitchen. All right. So we did put some hats on for tonight, and I donned it's colander?
Colander.
Colander. Okay.
Colander.
All right. We better actually get to work here. Our audience is going to get mad at us. All right. You guys all know the disclaimer by now. We do this every month. No investment recommendation whatsoever is intended. This is all about education. It's about taking the stuff, the really neat stuff done by the modern investment club movement, and talking about the methods, the practices, philosophies, and analytical techniques, and ultimately the taking care of a well-constructed portfolio. Everything we do is for illustration, but we do talk about real companies in real time, and we might talk about things that we own, and we'll generally let you know that. So again, do your own homework, please. Here's our standing agenda, and you can see I put that kitchen utensil on the left-hand side along with a picture of the eclipse. But here's our standing agenda. If you're new here tonight, a big hearty welcome to you. When we get to the audience poll down to number 8, everybody is welcome to join in. We do try to keep this fairly informal. You see the 4 stock selections by the 4 of us, along with a couple of challenge situations. We do talk about the results we get, and we do leave the microphone open for a few minutes afterwards to take care of any open questions and and try to give some answers before we close things down. Just a quick reminder what we've been doing, again, for a little over 7 years. We're simply calling to your attention an investment opportunity that could be meritorious of further study. We do keep track, and we hope that the stocks that we pick will go on to beat the S&P 5, or excuse me, the Wilshire 5000 by 5 percentage points. We'll take a look at how we're doing here in a minute, and we would like to see the majority of the selections that we make actually beat the market during the holding period for each and every one of them. Here's a look at a couple of things that we would like to take just kind of a brief time out, maybe kick around for 5 or 10 minutes. All knights and damsel are welcome to join in, but this is a subject that kind of came up as we were rolling around through the Pennsylvania Turnpike and in the hills and valleys of Pennsylvania. We were talking about this eclipse that was going to be happening in the coming week, and this notion of how we treat risk and how preoccupied most investors are with trying to avoid the situation. People try to do market timing. They try to do very fancy asset allocation. And what you're looking at here is a picture of our tin cup model portfolio. Again, just for a little backdrop for what that is, we take the maximum amount that you could invest into a 401k since the mid-1990s and put it in this model portfolio called tin cup. The thing about it is it chooses stocks just the same way that we do. It's a bit mechanical, but it's also always fully invested. So it's 100% always invested in stocks. So therefore, it was really exposed to the bear market that came with the Great Recession of 2008, 2009. And that's what you see in the center of your screen there, this grayish recession period, which was brutal. It was as brutal as anything that any of us have experienced as investors. But what we like to draw attention to is, again, less than a year out of that recession, we found ourselves back even above where we started and basically just marching forward and making progress. So again, for somebody that is not in a situation where they don't need any more money and they truly are protecting all assets and perhaps are near the end of their life expectancy, for anybody else in the room that's not towards the twilight years, according to life expectancy, we really believe you don't have to pay a whole lot of attention to asset allocation. And that I would argue that a whole lot of capital is really destroyed by obsessing over this notion of risk, stock price volatility, and obviously the market index behavior as risk. So it's a frustrating thing for me when we can see this type of thing demonstrated in club after club after club and in our individual portfolios. What are your thoughts about how people should think about market timing? We can start with you again.
Well, Mark, I know that I did my background's education. I've worked with teachers my entire life, and during the Great Recession, I was asked to come into a number of different teacher groups and talk to them about their investments, where they were investing in 403Bs, not 401Ks, but they're sort of the same animal. And what I was just disheartened to hear on a regular basis was that at the very time when people should have been moving from anything that they had in, quote, safe money, unquote, they should have been moving to the stock market, they were moving the other way. They were taking their money out of stock funds. They were taking their money out of good solid companies and good solid investors and turning it into fixed income entities. At the depth in 2008, I visited my own faculty that I had retired from just a few years before and tried to convince them that it was an opportune time to be buying, and instead they were converting their entire retirement funds. They were converting to fixed income. Well, you see what happens from the depths of 2008 to the present time. Tin Cup, which is pretty automatic, just dealing with good solid companies, nothing fancy, has significantly outperformed the Wilshire 5000, which is the entire stock market. And I think we see these examples in a lot of different portfolios, a lot of different examples that can show us that if you don't have to be fancy, you don't have to go after the latest, newest thing. You can just look at nice, old, regular, vanilla kind of companies, and you can still do fairly well in putting together a nest egg that outperforms what the regular market might be doing.
Yeah, it's a staggering difference if you can find the patience and the courage to stick it out. I think we'll turn it to Hugh. I can remember fondly. Well, I don't know if fondly is the right word. Hugh was all over the early days of the Great Recession. He did some awesome work back in that time frame, putting things in context for us. And I guess the question I would put to you, Hugh, is we're starting to see that type of warning signals from a lot of the leading money managers and the gurus and talking heads. They keep talking about this market being so topped out, and I mean, in what how do you see that and placing it in context versus what happened during the Great Recession? Any thoughts on that, Hugh?
You can hear me okay, can you?
Yes.
We can. You're a little bit tinny, but we can hear you.
Did you say thin or tin?
Tin.
Well,
darn.
I haven't seen you personally recently, Hugh, so I can't comment on your thinness or not.
Okay, fair enough.
Keep chasing those wolfhounds. You're probably thin.
I think back when the Great Recession was starting, I mean, most of us in the investing club movement don't really look at the market overall. We look at companies. And back then, there were a lot of companies that suddenly got spectacularly cheap. And now they're all complaining, I think, that things are starting to get overvalued. And it could well be the case. But the fact of the matter is that to some extent, earnings really haven't recovered in many of the larger companies back where they need to be after the Great Recession. Yeah, there's bound to be a pullback and interest rates will go up, and I'd be surprised if we don't have some kind of accelerated inflation. But, I've discovered that the best thing to do is just keep motoring along in the stock market. Yep. It rewards people who are patient and committed.
Yeah, it still does come back to buying good companies when they're on sale, and don't stop doing that until we can. So yeah, it's a pretty interesting thing. And then here's the other slide that kind of was a shocker to us this past weekend. That I think it's actually pretty cool. And this revolves around a couple of different areas. Those who believe that the S&P 500 has been getting pretty much red hot, it's right there. You can see that the S&P 500 from the depths of the Great Recession has made almost a meteoric ascent, and it has actually caught up to all of the companies in the value line arithmetic average. And again, the value line arithmetic average is an equally weighted index, which is formed from all 1,700 companies in the value line standard edition, including all of the S&P 500. So, I mean, we look at this, we see things like the lost decade in the S&P 500. You see the big run up from 2009 until present conditions. But we also look at, we've always used this graph as showing that the small and medium companies could be bought and would be outperforming the S&P 500. Well, for the second time in the last 25 years, the S&P 500 has actually caught up to the overall average. And there's just a few things. Go ahead.
Could you be real clear, Mark, on which part of this graph is showing the S&P 500? We're getting a little bit of confusion from our audience.
Okay, the S&P 500 is denoted by this blue mountainous area. This area here, is that coming through okay on the slides?
Yes, it's coming through very well on the slide. They just didn't know which of the lines represented the S&P 500.
Yeah, it's the blue shaded area, so the backdrop here is how the S&P 500 has behaved. And I just want you to notice how turbulent, how rocky, and how flat, and then how rocketing it's been here in the last few years. And compare that versus the 1,700 stocks, which is the bars, running right up the middle is the value line 1,700. And again, keep in mind that we encourage people it's a great way to think of investing in this thing we call all of the above investing, making sure that your portfolio has enough small, faster growing companies, medium-sized companies, and large cap stalwarts, blue chips. And you want to have a good mix of the three. And it's very unusual to have the S&P 500 catch the value line average. And the other one usually leads, and it leads because of the workhorses, the medium companies, and the smaller companies. But the thing that I kind of take away from this, and we can kick this around for just a minute, is my interpretation of this graph, at least over the last 25 years or so, is that the small and medium companies have been less bumpy. There's actually less risk over the last 20 years or so investing in small and medium-sized companies. Because keep in mind that S&P 500 is embedded in that line, and we'll probably do a little bit more work on this, but it comes back to this notion of you don't have to buy markets, you can find exciting, promising, up straight and parallel, small and medium-sized companies.
Mark, is it important for us to recognize that today's S&P 500 is being dominated by a dozen or so of the largest cap stocks in existence, and maybe compare that to what was happening the last time the S&P outperformed? It looks like it was into the tech bubble and beyond when it outperformed. Was it being dominated by such a small number of companies at that point, or don't we have a handle on that right now?
Well, I think it's always been dominated by a few companies up at the top, the 20% up at the top probably contributing 80% of the kick. So that's pretty much always been true. They've kind of rotated, taking turns as to actually who that is providing that.
Well, I'll give you a statistic that was laid out by somebody on one of the business channels in the last couple of weeks that indicated that at the turn of the century, it took somewhere between 150 and 200 companies to move the S&P as fast as the top dozen can move it today. So I guess he was trying to point out that there's a real disparity between how large some of the capitalization has gotten on some of these the Apples of the world, the Amazons, the Teslas of the world, compared to the way it was at the turn of the century. That it took a lot more companies to move the S&P than it does today. And I just was wondering if we could verify that as a fact, or whether that was just something that somebody was blowing smoke. There's a lot of smoke being blown on these channels a lot of times.
Well, I can't say the specifics, but that condition is alive and well today. And there's actually people that have some concerns about the amount of passive investing in index funds that's giving too much price support for companies that don't necessarily deserve it. And so it's something we're thinking about. And one last thing I would point out here is 5 years ago, we were all over the S&P 500 companies claiming them to be undervalued. We would find less of them today. Hugh has had a field day over the last 5 years with some of his larger company selections for the roundtable, and he's going to bring one tonight that I think still fits the pattern of being kind of stuck in the molasses back there as much as 7 to 10 years ago. Any further comments on that, Hugh? Or
yeah, sorry, went dead for a second, but I would, if you look at 100 years ago, it was a lot easier, I think, to do a fundamental, in some respects, a fundamental analysis of the company. We have more financial information then, it's probably more accurate, but there can be legitimate arguments about what the value of an Amazon is. But if you had hard assets on the ground, as you had for many companies 100 years ago, I think it was a lot easier to assess what that company was worth,
Mm-hmm.
And then I think the other challenge is, and this is something I think that really has come to the fore in the last 20 years, is that the financial reporting cycle of quarterly numbers is not much slower than the technology innovation cycle. So by the time you get a handle on the finances of a company and its trend over a period of time, the technology has already changed and it's essentially a different company. So again, that makes it harder to evaluate the company, and I would argue probably makes it more volatile and could potentially make it severely overvalued at times and undervalued at times. But I remember looking at this a few years ago, and yeah, about 10 or 20 companies were a much bigger chunk of the overall market today than they were right after the war, let's say.
Mm-hmm. All right, this is the theme we'll probably come back to a little bit. We continue to believe that it makes a whole lot of sense, and underline that and bold it, that to invest in small and medium-sized excellent companies. So we'll keep pushing on.
Mark, I'm going to interrupt for just a second, Mark, and ask Kim if she can hear us and if she can speak now. Kim, are you with us?
I am with you.
And we can hear you loud and clear. Whatever problem you had, you've been able to solve. So welcome, and we're glad you're here tonight.
Well, thank you so much.
All right, let's go ahead and press on. We want to leave Kim plenty of time for her presentation tonight, too. Let's take a quick check-in on how we're doing. This is actually a lot of fun, too. Our rate of return is approximately 13% since inception over the past trailing 7 years. We're getting about half of the picks right. That number has been increasing fairly steadily. And the relative return, the market actually had a pretty tough month while we had a pretty good month over the last 30 days. Cognizant continues to help us along pretty well, thanks to Mr. Lynch's multiple selections of Cognizant. And there's a number of companies that have actually behaved and outperformed the market that have carried the portfolio. Our relative return is now about 3.5%. That's 3.5 percentage points better than the market, and we'd really like to reach that 5% line at some point in the future. But it's cause for celebration. You might even say that we're at a new high. We're getting close to eclipsing, pun intended, our all-time high.
This is our longest string of monthly increases since way back in our third year of operation, when we had 6 months in a row where the dots went higher each month. So we're at 5. So if we can do one more month, we'll tie our best, and maybe we'll beat the all-time high for the portfolio.
Let's hope so. We'll keep crunching along and hope for the best.
Persistence.
And again, this is just our reminder that 3.5%, that 13% doesn't necessarily sound sexy or fantastic, but we declare this to be a yawn-free zone. I'll let you read the caption tables here. It's pretty special performance, and we've got a couple of people on the panel even tonight. I won't name them by name, but one of them's in Florida and the other one's in California. Are actually topping these performance levels. So,
well, and Mark, since we did this slide, since you put this slide together, that bottom window should now read 3.5 plus.
That's correct.
So that probably pushes it up that list of 39 out of 26,000 a little bit higher.
Could be. All right, let's go ahead and these are the companies on which the portfolio performance is built. This is listed by percent of assets or by the total value of those assets. As we were saying, you can use the legend at the bottom. What we do is we invest $1,000 every time a selection is made, either by a knight or a damsel or the audience. In the case of Cognizant at the top of the chart, and according to the legend at the bottom, it's been selected 12 times. That means $12,000 has been invested in Cognizant. It's now worth $21,700, so it's had a pretty good bump here of late. Apple has also done pretty well here lately. $8,000 invested in Apple, as you see down in the bottom legend, is now worth nearly $18,000. And these are the companies that are kind of carrying the ball these days. So from top to bottom, you see this by position size. So therefore, these are the 20 most influential stocks in the roundtable portfolio. There's about 90 active positions in the portfolio, and you can actually reach that portfolio via the public dashboard using the link at the top of the page. You don't have to be a Manifest Investing subscriber, although we would love you to join us in order to access that. Up at the top, you just type that in. Any thoughts or comments on any of these from the rest of the roundtable? And hearing no comments, we can probably press on. Everybody's muted, I guess. But there's some pretty good community favorites in there. I guess the one point that I would make is there's a pretty healthy dose of companies with asterisks, or those little stars after the names. That means they're not in the value line standard edition, so it's indicative companies that are kind of off the radar screens. And we do like to find those whenever possible. We will probably be upping and doubling down on our efforts to do just that over the the second half of 2017, because we think that there are opportunities to discover those smaller, promising, exciting companies out there. All right, so let's take a look at our portfolio-centered decision concept for taking care of the tracking portfolio. Again, it's just like a normal portfolio, except that we don't place limits on the number of companies, so the number of holdings actually do pile up as we bring these ideas. But again, as companies deserve to be set free, as in the case of Vera Bradley probably tonight, Vera Bradley is actually a 3-time selection, so $3,000 invested is now worth $1,000. That hurts when that happens, and there's not a whole lot of good things happening with Vera, so I was going to throw that one on the pile for motion to sell. I think the Chronicle kind of captures it. I really like the stuff that they do. I like the people of Fort Wayne, Indiana. I like everything about this company, except for, sometimes things just don't seem to work out so well. The stock price has kind of rebounded a tiny bit on the right-hand side of that chart, but I think all of us are kind of disturbed by the rather steady degradation in quality. And again, that's not anything emotional. That's just simply putting together all the pieces of financial strength and the straightness of lines on the stock selection guide and various other things.
Well, and a lesson that we're learning, Mark, from watching these ones that go onto the hot seat, and it should have made ultimate sense to us right up front that probably we should have been not only monitoring the par for many of our companies, but I feel real strongly that we should begin to be monitoring the quality also. If we would have decided at the second big downturn on Vera Bradley's quality that this was time to sell, Mark's kind of pointing to it right now, we would have preserved about $1,000 of the $3,000 that existed. I mean, that would be selling it at about, I don't know, can you follow it over to the side?
In the 20s.
That green bar in the 20s, and instead we're selling it in the low teens right now. Is that right? Selling it around 11 or 12?
Somewhere down around 10 in fact.
Yeah, down around 10. So, if one of our rules is to not only make some money, but to try to preserve your capital, we buy based on quality. I think that one thing we have to start watching is degradation of quality, and when quality sinks to a certain point, Manifest has the capability of telling us when quality crosses a certain threshold. So maybe we should be taking advantage of those alerts and placing a stock onto the hot seat when its quality is sufficiently degraded that it probably would not be at a level that we would purchase it at anymore.
Absolutely. So I'm going to go ahead and suggest that we go ahead and set Vera free for now, and hope that they do have a turnaround in business and that we can continue to watch for them to do well, but kind of close this one down and see what happens.
You have my support.
Any dissent?
Yeah, agreed.
All right. And Kim's going to replace it with another Indiana company, so she'll be all right.
We're going to go RVing.
All right, there's a couple of companies that actually fall into what we're referring to as the Rule of 5 trigger. And again, this is we don't want to go too deep into it tonight, but this is our attempt at using the relative return, in other words, how a company has done versus the market since the time of selection, as a potential trigger. Anytime it falls 20% behind the market over its holding period, we basically are going to throw it on the hot seat. In some cases, we'll do an automatic sell. There's two companies tonight. One of them is Under Armour. I don't want to talk about that one because I like that one too much, and I'm emotionally attached to it. This one is Synaptics, though I'm not emotionally attached to this. I did select it back in February, and it has completely fallen apart over the last month. Now, again, there are those of us in the audience that believe, yeah, they might turn things around, but the whole spirit of this particular trigger is to call a timeout, literally give this company a timeout, dismiss it from the portfolio if we all decide to do that, and notice that it's taken a good 20% plunge while the market's been going up. So it's really lagging quite a bit, and I'll just go ahead to the next slide and show that, yes, and it's even a case where that quality ranking has begun to approach, going from excellent to just simply good, very good, but still good. But it's taken quite a hit over the last few days. And again, part of the premise of this, if you go back to our case studies, including Iconics brands, that went from $100 to $80, and we sold it. And the next thing we knew, it went from $80 to like $10. So we're trying to avoid that with situations like this. Any thoughts?
How many positions do we hold in Synaptics, Mark?
Just one, I think.
Just the one? Okay. Mm-hmm. Then that makes it real easy for me. I say let's continue with our experiment, and it's certainly not a core holding, and it's met the requirements for us to push it out of the portfolio, so let's push.
Yeah, just walk away and call a timeout. Kim, your thoughts?
Yeah.
Push it away. If we don't have the quality with it and it's degrading, the quality's going down, just eliminate it.
And it's not like we don't have enough positions in the portfolio to take up the slack. So any dissension from the West Coast?
Nope, I'm fine.
Okay. All right, so we'll go ahead and set those two free tonight, and we'll come back and take a closer look at the portfolio next month as we go back to school. So with that, let's go ahead and make a transition into the stock selections. We're going to start off with Ken Kavula and FleetCor Technologies. So go ahead, Ken, take it away.
Okay, well, I'm going to premise my remarks with a discussion or a little bit of an announcement of the fact that Forbes magazine has come out in its most recent edition with a list that I found extremely interesting. I used to watch with bated breath when the issue came out of the 100 best small companies in the country, but they put out a list in this last issue of the 100 most innovative companies in the world. Now, there's a page that sets the criteria for them choosing how to name a company to this list, and you can go to the Forbes article. It's on the free site, Forbes.com, and you can read the criteria, and then you can view the list. I've put them onto a dashboard, and I've offered the dashboard to Mark, and he's going to add it to the public dashboards in Manifest. And I was interested as I read that list yesterday. Today's Tuesday. I read it on Sunday. I was interested in finding FleetCor Technology in the top 20 most innovative companies in the world. I know FleetCor because my wife happens to own it in her IRA account, and she and I have studied it off and on for the last, 2 or 3, maybe even 4 years. So because it was on that list, it brought it back to my attention, especially because on this last Saturday, I had presented it as part of our presentation to the Harrisburg chapter. So let's start by clicking once. In Harrisburg, I was talking about the triple play, and I've talked about the triple play off and on at the round table. A number of things, 3 things have to be true. And then Mr. Nicholson said, if you found a triple play, then you had a good opportunity for a great stock idea. It's not the idea that you go out and buy it as soon as you see that it's a triple play, but it goes to the top of your best ideas to take a look at. And I had gone through the August 11th value line page by page, turning the pages, look at 4 triple plays, and noticed that FleetCor Technology had jumped out at me on the triple play right there, along with 4 or 5 other companies. I will tell you that there's one company that I left off the list because I didn't want to complicate the business model, but Charles Schwab was also a triple play from my point of view, even though it has a business model that doesn't deal so much with net profit as it deals with some other measurements. So FleetCor was on this most innovative list. Now it comes up to me on a triple play list, so I looked at its value line, and that's the next slide, Mark. And the triple play is pretty simple. You're looking for a depressed stock price. Well, with the average stock poised to return around 7.5% for the next 5 years, I think that if this stock at the low side can be returning double that, around 14%, with a top end in the mid-20s. I think that that's indicative of a depressed stock price. It has a lot of potential price-wise to make up. So that's number one on the triple play, depressed stock price. Then you look at the PE value. Now, this slide is a week and a half old, so the PE value for FleetCor is probably a little bit different than 18.6, which it was when this value line was published, but that's close enough to compare to their 3 to 5 year average PE call for the stock, and you'll notice, and I pointed to it, it's down there in the mid-20s. So that's certainly PE expansion, and that's leg 2 of the triple play. Leg 3 is the chance to have margin expansion. And I'm looking at the current margins. Remember, Mark's going to change the red box because it was hiding some of the numbers. We look at the current margins, and remember, you're looking at regular type. Don't look at the boldface type or the italic type. Those are estimates. But the most recent fiscal year from 2016, the margin was in the mid-20s, and then you slide over to the far right of that thing, and you see that Value Line thinks that the margins might expand to as much as the mid-40s. Whether that's believable or not, even if Value Line would have said that that was going to expand to 29 or 30, that's still margin expansion, and that's the third leg of the triple play. Again, this doesn't mean you run out and buy it. It just means it's a really good stock to take a look at and to study. So that's what I did. I then went to one of Mark's slides that we used in the presentation last Saturday, and Mark had pulled together companies that had really good short-term prospects. FleetCor happens to be rated 2 in Value Line, which means it has pretty decent short-term appreciation potential. And then Mark pulls together a number of slides, and he shows you different opinions, short-term opinions, coming from a number of different sources. And the very fact that FleetCor is on this list means that it's comparing favorably in the short term. The triple play says it's comparing favorably in the longer term. It's on the list of most innovative companies, and all this is happening almost simultaneously, so it becomes a very interesting study for me to push forward. If it turns out that everything's looking good, then I think that I'm going to be recommending to Natalie, my wife, that we're going to increase our holdings in FleetCor. So let's take another slide here, Mark. I went to the Chronicle next. That's the place that I normally go because I was checking to see if quality had any significant degradation in the last 2 or 3 years. And I see a pretty flat quality line. If anything, it's moved just slightly up and maybe just slightly down in the last 5 or 6 months, but really very, very nice and steady. And I'm looking at that red line, which indicates par. And the par at the end of the most recent month that we've grabbed here, which would be July, the par is pretty decent, and it's pretty high for when you compare it to all the rest of the pars on the graph there. So I'm going to kind of put that par value into my head. At the end of July, that looks like it maybe was somewhere around, I'm going to say 12 or 13, something like that. And I'm just going to kind of keep that in the back of my head. I'm looking at the current par. It's at 14. Really nice quality on the company. And again, not much not to like. Let's continue the study. Click again. I always look next to the Chronicle, next to the stock page, because I get a comparison of FleetCor within its own industry, that's credit services industry. I find some of its competitors and peers. I recognize Visa and MasterCard. I don't have to recognize all 5 of them, but it's interesting that FleetCor is at the top of the list based on manifest ranking. Again, another positive thing. I'm looking in the entire financial sector, and here's Charles Schwab, another one that I had considered as a triple play, and then there's FleetCor sitting in second place in the entire financial sector. So again, I'm feeling really good about the company. So I go to their website, and their website says this is where they make their money, most of it coming from fuel cards, branded fuel cards. They just most recently got the business from Speedway. If you have a Speedway card now, that's really FleetCor. And then you can see that their cards also help pay for lodging and tolls, and there's gift cards out there, and there's corporate things out there as well. So I keep going on the website, and I see that they do a lot of their business in the U.S., but they have a sizable presence in the U.K. and in Brazil, and they're building a presence in other places throughout the world. In fact, FleetCor itself feels that this is the primary growth driver moving the company into the next 5 to 10 years. So I see how they're telling me they're going to grow, and it makes sense. They've grown really rapidly in the U.S., the UK, and Brazil. They'll continue UK and Brazil growth, and they're going to move into other parts of the world. Click again. It's a recurring revenue. It happens time and time again. Think Visa. You understand Visa's business. Visa doesn't handle the money. Visa just handles the transaction processing. Well, that's what FleetCor does for a whole host of privately branded credit cards. It's a diversified revenue stream coming from all parts of the world. Very high margins. When we get to the SSG, we're going to see the margins and extremely low capital expenditure requirements. You don't have to build factories. You can handle these things in offices, and they can be placed in lots of different places throughout the world. Big margins again. So it's a business that has a good solid footing, and you have some visibility going forward. Click again if you would, Mark. I like a company that people don't think is doing a lousy job, and I think by the number of complaints being filed to FleetCor, compare it to some of the other companies which you might be familiar with on this list, you'll see that their complaint basically moves down to about one complaint for 40,000 invoices. That seems to be quite manageable, and it means that they're doing a job that people are not really telling them is done really poorly. You can see the numbers of complaints from those other companies there. So we're dealing with a company that people seem to think is of a high quality as far as the service is concerned. Click again, please. Here's some the math for the company. I focused in on 10% organic sales growth and 13% organic earnings growth. But at the top, you'll notice that their objective is to compound earnings at 20%. That tells me that they're involved in acquisitions, and they're expecting acquisitions to add about 7% growth in earnings. And you can read the rest of this slide yourself, but it's pretty interesting. They do throw off a lot of free cash, and at the present time, that free cash moves right back into the business. They make a lot of small acquisitions on a fairly regular basis. And it keeps the company moving along. And what I like is that they don't tend to buy things that they don't understand. They buy things that complement the portfolio they already own. You can see the lines reasonably, very up, reasonably straight, reasonably parallel. I do like to see those kind of lines on an SSG. I think I was very conservative in my sales growth number and my earnings growth number. I think I predicted in the mid-teens. The company is much more optimistic based on its own guidance going forward, and the analyst community is much more optimistic than I was. Click again, Mark. I see that there's fairly decent profit margins, and they're at a high level. And even though it shows red, I'm looking at the last 2 or 3 numbers, and I'm telling myself I don't see any disruption in that first line in the fourth that's going on there. I know that they have a reasonably high debt level because they are active in their acquisitions, but they don't carry a lot of high interest debt. They're able to borrow money at a really low rate. even lower than the low going rate for money. So that means that the banks must respect them quite a bit. And that return on equity number isn't very clean because of all the debt. So I'm not going to take a lot of time trying to move through it, but I'm reasonably happy with those measurements on management. I see that the current PE value in Section 3 of the SSG is really very close to the 5-year average PE value, and that's comforting as I'm looking to buy a company. So click again, Mark. I've chosen PE values going forward that are very close to the 5-year averages because these PEs have been fairly well behaved. And when I do all the calculation or let the computer do all the calculation, I do see that it ends up in the buy zone. And click again. Here's the payoff for any SSG as far as I'm concerned. What is the upside, downside, and what's the potential annualized return? Well, my SSG shows a potential return of around 15%. Remember, Mark was indicating 14%. You know, those numbers for my purposes are close enough together that I'm getting the validation from Manifest that I'm expecting to get. That means there's no surprises behind door 3 or door 2 or whatever. No zonks to worry about. So click again, Mark. I'm just comparing the numbers that I used against the numbers that are coming from the analyst community in Manifest Investing, and you know, I feel that they could be just as right as I happen to be. They come up with 14% going forward. I'm very comfortable if that's the answer, or if my answer of 15 is better, or if the answer up around 19 or 20 is better, which is where Value Line says it might end up 3 to 5 years from now. I'm happy with all those values, so I'm going to suggest we add FleetCor Technologies to our portfolio, FLT.
You know what makes me happy, Ken?
What makes you happy, Mark?
Well, besides you being happy, swinging by Punxsutawney, Pennsylvania.
Okay.
All right.
I had to listen to that, folks, for an 8-hour drive about why we couldn't take a 2-hour detour to go to Punxsutawney to see the groundhog.
It's somewhere in your future. All right, we're running a little bit short on time, so let's go ahead and switch to Kim and LCI Industries. Fascinating study in the manufactured vehicle arena, recreational vehicle arena. Let her get back and unmute it here. And she's seeing this sequence of slides probably for the first time.
Mark was such a kind soul. I sent him the information, and he can develop a PowerPoint because that would take me about 2 days. LCI Industries is a play on the younger generation of millennials who believe in investing their money and having vacations that won't cost as much because they have a little RV, as well as those who are retiring. So you can see from the Wall Street Journal, they had this graph out here as to see how demographics are using RVs. On the left-hand side, you can see what your SSG is, pretty well straight, pretty well parallel, so it's doing well there. And that's 1 year I went to Berkshire. So next, I thought about anytime I read an article somewhere, it makes me, I don't know, my brain now works, okay, how could I make money on that? I saw this article in USA Today and how millennials are fueling new growth in recreational vehicle sales. And the other thing I kept thinking is if you're going to have all these RVs, somebody's going to have replacement parts. So who is the leader in replacement parts? And it turns out it is LCI. LCI. So OEM is original equipment manufacturer, and they have a huge back orders. And dealers are having a hard time keeping up. And if this is an area for growth, I'd like to make sure I was a part of it. Next slide.
Kim, I'm going to interrupt you. We're getting a lot of questions. Is LCI Industries the former Drew Industries? And the answer for all of you out there is yes.
Yes, it is. They revamped their name. This is from their PowerPoint from their last quarter earnings, and they will be giving their next PowerPoint or their next quarter's earnings here. They just did it like on August the 9th. So next slide. This is how much their growth has been from 2010 until now, and as you can see, nothing to complain about. Over 20-25% in most areas and 38% in the aftermarket or in the original equipment in the motorhome. Next slide. And this is how they do with their growth. They have had acquisitions of 26%, organic growth of 27%, and the whole industry overall has grown since 2013. So I think this is an excellent growth, and I recognize that with this kind of growth, it might be because interest rates are very low, and as interest rates go up, I recognize that that may change a bit. Next slide. You can see here where their sales are for their Traveler and their fifth wheel RVs, and how well they're growing up and how they expect it to go up in the future. These are their projections for figuring out all the way out to 2017 or for this year and going forward. And it is their divisions of their motorhomes, their towables, travel trailers, and their RV segment. Next slide. They're very optimistic on how millennials, and I can say especially family that I have myself personally, they want much more family vacations. They want to be together. They want to have not necessarily be in a hotel room, and they'd rather invest their money in something that they can go travel in because they feel it's cheaper. And for a family of 4, I've got one family member who's got 5 kids, so it's more like 7. Everything is cheaper to be in the RV because to be able to do something. And those of us who are getting to retirement, we enjoy traveling and we enjoy getting out and outside and having fun. So, and I know that with me having a family member who now lives in Columbus, Ohio, I am hoping and praying I get invited to an Ohio State football game, and I will be doing some football games with some tailgating. Next. They are very, very disciplined on how they do their acquisitions, and they are able to integrate them very well and keep their margins pretty high. So this tells me that they've got excellent management, and if a management team can do great capital allocation to get the company to continue to grow, I think it's wonderful because that's even better for me. Next slide. As always, it's important for us as investors to see what the financials are doing. And as you can see, if you're looking across this graph on how well their financials are, and the return on equity over 26% in the last quarter, return on assets 18%, ROIC, which is capital allocation. And I really have a requirement for those stocks that I have in my portfolio to have great capital allocation. Very low debt, and I think the biggest thing that if you really want to look at these numbers is look at how they have steadily increased. So that also shows a management team that is very shareholder friendly because they want to get great capital allocation from the company to grow for you. Now this is the value line. I have certain requirements personally that I like to have for my stocks. As you can see in the 2020 to 2022 projection box, I minimally will have to have the low price at annual total return has got to be over 10%, and here it is 15, so that's wonderful. My PE ratio is 15.3, the trailing is 17, and the medium is 18, so it is below, as Ken talked about, and in the future they expect it to be 20. So here we go again. We have a stock price that's down, and we have room for capital allocation for a PE expansion. I like to see on my stocks where that dot is up here, it's a little bit below the line, because that also will tell you that the cash flow, that this company is a bit undervalued. And if you want to look also at the cash flow per share of this company, look at how in 2013 it was $3.33. It's taken them in 2018. It's almost tripled. This company is letting more and more money follow to the bottom line. Here's the front of my SSG, and in being very conservative myself, I looked at what the value line was and what their estimate for growth was 10%, and I picked 9% out. The next slide, earnings per share at 12%. This is the back of my SSG. As you can see how well they've done. Debt to capital, ROE, all these numbers are good. The average PE on the stock is 18.3. The current is PE is 17.2, so that shows more area that we can have our PE expansion, which is great. Next slide. And granted, I see where I like it to know where insiders have been buying the stock, and this month actually the president of the company has bought 2 different lots of 1,500 shares at $94 and $95 a share, and today's price closed at $95.60. So I love it when the insiders think it's a great time to buy, because I think it is too. So that's great. And right now I may not have a 15% return, but I have a 13.7. So I'm pretty happy with that, with how our market is right now. If we have a correction, I think, I'm going to start a position here, and then I probably add more. And do I have any more slides, Mark?
No, I think that's it. Yep, that's it.
Okay, so I hope you guys will all consider LCII as a stock for your portfolio. And thank you so much for your time.
Thank you, Kim. It's a pretty solid looking picture going forward for that company. Again, that was the former Drew Industries. And in fact, I think you start at the Drew Industries website, and that the magic of the internet clicks you over to a new LCI website. So that's the way it goes. All right, let's go ahead and switch to Mr. McManus. Just to kind of kick things off a little bit, I just thought I would share for a moment as we transition into General Electric that he's not the only one thinking this way. This happens to be the ultimate stock pickers that's published by Morningstar. It came out just this morning, just to give you a feel for some of the companies being pursued by some of these very successful investors. And many of the companies you've heard talked about around here are on this list, including General Electric at the top. So you can see they consider General Electric to be pretty interestingly valued at 77% of the fair value. So let's go ahead and see what he has to say. He did select it last month, so this is a repeat selection of General Electric.
Excellent. Thanks, Mark. And well, there you see a summary of what's going on with General Electric, the kind of information that is germane for a stock selection guide, and for that matter from the Manifest Investing website. The thing that kind of really jumps out, and I hope everyone can hear me, is that things have been flat. That's sad, but I'll explain why, and I'll explain why I hope that they will not be flat in the future. To recap what we talked about last month, it's a Dow component. It was a much bigger Dow component last month. It's dropped from 222 billion to 113. But if it was good value when it was worth 222 billion, it should be even more valuable, as it has dropped 5% or so. And so it's one of the reasons that I like this company. I believe it has a future, and it has the other nice attractive thing of a low stock price. PE seems to do everything. I mean, we went through this list last time. The thing that is kind of grayed out a little bit is GE Capital, the financing arm that it bought some time ago, or got active in some time ago, and that really ended up being almost a death knell for the company during the Great Recession. I think it was very telling when GE, which makes things, when it was about to go under because of the financial crisis, that was a sign that this problem had spread and contaminated something you could imagine. They got a new CEO on August 1st, which is significant, because it's a person that is likely to further the changes that have started the company already, and pivot away from managing money into the other more profitable areas of power, energy, oil, gas, aviation, healthcare, transportation, and energy. And on the next slide,
Oh, I threw this one in here because I like the 20-year picture for the extended look at the company.
well, the point of the story is that you can see from that enormous dip back in 2009 that GE suffered significantly during the Great Recession, and it really has not recovered. What's interesting about this company is if you look at its peak back in late 2007, that's when the mark-to-market rule was kicked in, so that you had to value assets at the fair market price. And right at the dip in March of 2009 is when that rule was rescinded. So there was kind of a clear signal that the market was going to recover back in March of that year. Value Line tells a very similar story, but with fewer years. And unfortunately, I cut out the caption here that shows the year, but you can see in the gray area towards the left of this bar chart that we're looking at 2008 and 2009. So it goes all the way back to 2007. And you can see that the stock price hasn't recovered. And here's a telling thing, again, from the Value Line Investment Survey, which is free to download from Value Line for any of the Dow Jones Industrial Average 30 companies, GE being one of them. But you can see that its revenue per share was a lot larger back in 2008 and has dropped significantly since then. Cash flow has suffered a little bit too, but is on recovery. And the dividend took an enormous whack back in 2008, where it was $1.24. It was cut in half in response to the financial crisis, and is back at 92 cents today, 96, excuse me, and hasn't really recovered from where it was at its heyday. So revenues are pretty unimpressive. Cash flow has faltered. Earnings tell a little bit of a better story, but bad news for investors if you're using this as an income stock, because as many did actually, because the dividend has suffered. So there is a lot to complain about. And on the next slide, you can look at a download from Microsoft Money, which shows how the earnings per share has performed. And it did take a dip in 2015, but a lot of that had got to do with the fact that its balance sheet had started to get messed up because of selling off assets, and revenue suffered as a result of that, which is the top light green line. Net income has been fairly stable over that period, at least it's recovering from selling off a big chunk of the company in 2015. So if we skip forward to the next slide, as Mark pointed out, there are many, many funds which own GE, and some of them are starting to buy many shares of the company too, which is a good thing. GE tried that itself recently. It has invested billions in terms of bumping up the dividend, not back to where it used to be, but increasing the dividend, but also with share buyback programs. But the stock price really hasn't reacted to that significantly. Next slide. We look at a summary from Manifest Investing. We look at the income portion. And again, the take-home lesson here is the projected annual return for this company is just over 15%. It's well within the sweet spot. And it's a high-quality company, having a rated ranking of 96. Its sales aren't growing that dramatically, but they are growing. And the earnings are growing a little bit faster than sales, something that long-term is not sustainable, but it's a good sign as it pivots into more profitable businesses, and as the company says itself, gets more involved with the companies with which it does business, understands their business better, and sells up. It's very good financial strength, reasonably good earning stability, somewhat stable sales growth rate, and fairly average profit margin for its industry, maybe a bit on the low side right now. Hopefully that should improve. But the next slide summarizes information from Manifest Investing website that shows comparables within the industry. And again, GE has a lower quality than its peers, but it seems to have a slightly better projected annual rate of return. And when you compare over on the left, you're looking at companies like Danaher, GE, etc. GE is a very high quality company with a higher growth rate than many other companies that would be in similar sorts of markets. And I think there's an eagle on the next slide. Yeah, but it just summarizes the information. I didn't really change much here, if anything. But it shows the annual rate in sales. Not impressive, but the fact of the matter is that given its dividend yield, 3.5%, and coupled with faster growth in earnings than in sales over the next 5 years, company is projected to have an annual return of over 15%. And then if we skip along, we can see how the quality of the company, the blue line, and the projected annual return, the maroon line, I guess, start to converge, but this has been growing as the stock price has declined. So let's move on to the next slide, because here I just talk about what really I discussed before, recent history. This company has a very proud legacy. It's been in the Dow Jones Industrial Average for 110 years, longer than any other company, and it is a survivor. 200 plus companies have been into this index and have left. Many of them have left to ultimately suffer the ignominy of bankruptcy. But GE has been able to pivot, and it has pivoted a number of times. It's been in multiple different industries, some of them unrelated. If you look back at what GE was doing years and years ago, yeah, it was always involved with electricity, but some of the areas that it's in now, it had never really been in before. Significantly different. So this company has the power to adapt. And the question is, will it be able to do it again? And it appears to be doing it. When the last month when I gave the presentation, I extracted a lot of information from the company website where it showed that in the new areas where it had pivoted its business, it was performing relatively well. And we skip over to the next slide. I just talk about, I guess, the bad side, the things that have been happening that have hurt this company. But again, I'll leave it up to you to go to the company website to show how it is addressing these problems. That's the bad news section at the bottom. It has had a negative return over the last 12 months. Even bought back 67% of its outstanding shares over the last 18 months. It does have a slightly higher dividend yield than the S&P average. Depending on what you look at, you're going to get a dividend yield from 3.5 to 3.7%. If you use its current dividend of 24 cents a share, it comes out just over 3.7%. And there are things that are threatening the company. It did suffer in the nuclear business, although the nuclear business seems to be going through a kind of a mixed renaissance right now. Whether or not it will actually recover to its glory days, who knows, but there's certainly more interest there. The big question is, it's very profitable gas turbine business. Will that be threatened if coal is mined more aggressively under the new administration? We have to wait and see. But the important thing, and the one thing I want to stress, is that this company is in the process of reinventing itself. When a company is doing that, there is uncertainty, and when there's uncertainty, there is an argument about the price, and there's fear, and I think the price reflects that. My contention is that because this company has done it before, because it's in pivotal businesses, and it seems to understand those businesses, it will recover as the overall economy is recovering, and the company should flourish once again. And based on where the dividend is, I think we are very close to a floor in the price, particularly if the dividend is going to grow at 6 to 7% a year going forward, which cash flow continues. That's not an unreasonable assumption to make. And then we skip forward. Oh, we get to Zoe's kitchen for some reason.
Mm-hmm.
Spoiler alert. Huh?
That's the last slide.
I had one last slide that just basically said, yeah, I'm going to pick GE.
Oh, okay.
But I think people probably picked up on that already.
Okay. we'll go ahead and throw another order of GE on the fire. All right. Let's go ahead and, one of the things that I'll save that for later. Let me come back to a repeat selection. We're coming towards the end of the evening, but it won't take me long to do this. This is one that I covered last month. It's very unconventional. This is a company with a limited history. It goes back a few years before they went public, back in 2014, 2015. The name of the company is ZOES Kitchen. They specialize in Mediterranean food. The ticker symbol is shown there is ZOES. This is not a core selection. This is a more speculative selection. I would point out that we're almost up 30% since last month's selection. So hopefully we'll continue to see strength in this. I wanted to reiterate and reinforce where the idea comes from, because I think that's at the very heart of this particular selection. It comes from one of the top performing small company mutual funds out there, Brown Small Company Management. The ticker symbol is BCSIX. And what you're looking at here is a drill down into the brown fund. And again, Keith Lee makes very few decisions over the years. In this case, you can see that they have not sold Zoe's Kitchen, even though it's been down 60 or 70% since they selected it. I will be watching to see if Keith Lee and his team make a decision to go away from it, or perhaps even add some more, whatever. I want to see what they do with this, because they have about 1.6 million shares of it. And again, they have only about 40 stocks in the portfolio, fairly concentrated portfolio as mutual funds go. And again, as you can see on this next slide, they don't make these kind of decisions very often. You see companies on this slide, and this is just the bottom half of the 40, with purchase dates back in 2003, 2005, 2007. You can look down the list, and you can see that ZOES is something that came into favor and was finally selected and purchased by Brown Small Capital Management back in October of 2016, just in time to fall off the cliff. So we'll be watching to see what they do. Here's a reminder. This is what we were looking at last month. We were hoping that it had reached a price support level of being oversold, and it did turn out. This is what has happened over the last month. It's gone up 25 to 30%. So it's hopeful that they did find a bottom down there around that price level near $10 a share. This is my quick reminder from last month that this type of challenge to even an excellent management team happens to many companies. We used Panera last month to describe how some of the emergent challenges back at the turn of the last century was accompanied by some tough times during the Great Recession, and they just kind of fought their way through it. I actually went back to Panera Bread's stack of value line investment company surveys to prove to everybody that back in the late 1990s, Panera went through a period where they actually lost money and had negative earnings. So again, this can happen to even a well-managed company as they're going through their growing pains. Just a quick look at what's happened over the last month. We haven't seen any significant deterioration since the analyst consensus estimates from July are compared to the ones in August at the top of the page. No great cause for concern. Yeah, even if they've gone from an 18% growth rate to a 15% growth rate, that would not cause me to lose much sleep. Those numbers are basically the same for a relatively small company. Again, the thesis or the premise of what we think can happen with this company is they can expand into some fairly exciting turf. They are concentrated, very much concentrated in the southwest and southeast of the United States, and they have been very methodically and strategically expanding to the north and to the west. Some very fertile ground that yet to be covered there. I like the story. The food is good. Get good reports from people that have actually been there. Their strategy is to capture the female head of household in many places and basically bring the rest of the family in, and they just want to do a good job, very much like Panera or Chipotle or whoever, but they have opportunity to expand, and it's a pretty good strategy. Here's a look at the stock selection guide-based income statement. Again, focusing in on this notion of a company that used to be $18 and has now been down as low as 10 and has rebounded to 13, growing in the higher teens with a projected net margin when as the company matures. For a restaurant would be fairly normal to be in that 3, 4, 5 range. It could even be much higher than that. That would just simply be gravy. And a PE ratio that's fairly normal. And again, after the price drop, a fairly decent return forecast. Again, this is speculation. It'll be on a short leash. Certainly, if it fell 20% behind the market, it would fall victim to our rule of 5 trigger for a stop out. But it's an interesting story. And again, I just look at this as a speculative opportunity, perhaps in the same manner as an early day Panera or other restaurant of that kind. So let's go ahead and add another $1,000 of ZOES to the pile, and we'll see how we do.
Mark, we have a fair number of questions, but I'm going to go to the poll next, and I'm going to get our poll out there for our audience to choose one of these stocks. And the poll is now open. And you have a choice between FleetCor, General Electric, LCI Industries and ZOES Kitchen, or of course you can choose none of the above. I'd love to see 85, 90% of you voting. We're up to 65% right now, so just take your mouse and pick one. Help us out, make an audience choice. We just crossed the 80% threshold. I'm going to count to 10 in my head and then close the poll down. We're at 86%. Keep on voting, folks. Let's see if we can push it over 90. 89%. Come on, one more person is all we need to push it over, huh? There it goes, 90%, and I'm going to close the poll, and I'm going to share the results, okay? And they have put a big holding into FleetCor, 61% into FleetCor. So we'll double that position as we go. Let me hide the poll, and we're back to live roundtable now, Mark. If you want to go to the next slide, we can close the thing down, and then we can try to answer questions. Folks, we normally close the session down about this time, but we will stay and try to get all of your questions answered. We're going to be going to a new program in mid-Michigan. We're not going to stop the roundtable, but we're going to experiment with some action-oriented, some topic-oriented webinars. And the first one is going to be September 4th, and we're going to talk about better selling. I'm sorry, I read that date wrong. It's September 5th, and we're going to be talking about selling. All you folks from Michigan, we're going to be at the Brighton Model Club Jamboree on September 9th for an hour and a half of good, solid discussion about club investing. I'm going to be in the Inland Empire in Spokane in September. I'm going to be at the Rocky Mountain chapter in Denver in October. We're both going to be in Dallas. And we have the September roundtable date on our normal last Tuesday. But in October, the last Tuesday is Halloween, so we're going to move up to October 24th, and we'll give you plenty of notice in the email reminder at that point. And then we're going to finish out the fall season in Pekin, Illinois, for the Central Illinois, Heart of Illinois chapter. Mark and I are going to do a full day event on November 4th. If anybody in any of the chapters is looking for program, our calendar for the spring still has a few spots left over, so don't be afraid to contact us if it's something you'd like us to do, and we'll see if we can fit you on the calendar. Mark, I'll let you do some last roundup, and then we can close down and then answer some questions.
I'm wondering if Punxsutawney has a better investing chapter.
They might. You might have to go there alone, though. I don't know.
Well, we do look forward to being out on the road, and we actually look forward to putting together some other programs. I'd like to get Cy to do his risk presentation, or at least a portion or a summary of that. That session that Ken and I will be doing right after Labor Day is an encore performance, but we're going to be updating the presentation we made at the Better Investing National Convention on this topic that many of you have seen us wrestling with on better selling. Some of the stuff that we're trying to implement in some of these model portfolios. So again, we just look forward to opportunities, and we might even sneak out to see Mr. McManus or rendezvous with Mr. McManus somewhere in the United States and put a program on to get Hugh's name on this list, because
that might be absolutely wonderful.
Just a whole lot of fun to work with Hugh for a day or so, anywhere in the country. And for that matter, Kim, maybe we'll do both down in southern Indiana sometime. Who knows?
Sounds good.
We'll figure something out.
Yeah,
we'd like to thank you all for coming. Kim, a special thank you for filling in for Cy tonight. You know that we really enjoy it when you're able to be with us. And Hugh, I'm honored that you're able to take time out of your extremely busy schedule to give us an hour or so. We really, really appreciate it. Mark, you know how much your efforts are appreciated on behalf of the investors of the country, and they don't hesitate. They're not shy about telling you either. So I'm so happy we're able to do this.
With a few more votes of ZOES.
Well, that's different in voting for your company and telling you you're appreciated, okay?
All right. I won't take it too seriously.
Thank you, audience. And if you want to stick around, as soon as we close this down, we're going to answer a few of these questions that came through here.
Thanks, everybody.
We are going to close, okay?